Hello again viewers, welcome back to the next in our series of financial tips. Today we're going to be talking about saving income tax. Everyone wants to do it and we're one of the highest tax nations on the planet. So how do we go about doing the most effective tax or income tax saving methods? Now there's two real strategies that we look at here. Firstly, we can look at saving tax. Most people know they need to save tax if they can. I mean, every accountant will say, hey, you need to save tax. That's generally as far as it goes. But saving tax, is it as beneficial as utilising tax? And I'll be specific here. We can save tax very easily. We can put a vehicle in our own ABN and write down, a new Hilux or whatever it may well be. And that's going to save us tax because the running costs and the registration and depreciating the asset for when we sell it, that will save you tax. But is it creating you any asset wealth down the line? When we're looking at tax strategies, ultimately we want to be able to utilise it to create wealth, not just offset some of our income tax into a vehicle or a common asset that goes down in value. What about utilising it to put into and help pay for an appreciating asset that can increase your asset wealth? Well, that's a different strategy to just saving tax. There's two common ways of doing it. We can salary sacrifice into our super. And that's a great way of actually being able to save on income tax on that difference between the tax rate you're paying on your income tax as opposed to the marginal tax rates on your voluntary contributions. Great. Recommend that too. Another way we can look at utilising our tax into an appreciating asset is into a property. Because the average property, new property that is, if we're looking at a house and land for example, it can save you or give you between $30,000 and up to $50,000 worth of tax deductions every year. Now, of course, you're going to increase your cash flow. You might increase your cash flow by $20,000 to $30,000. And I'll talk to you how we can utilise that to pay down your principal assets too in another video. But what it means is, let's say we've got $35,000 worth of tax write-downs per annum. So if you're earning $150,000, the ATO will then, based on a $35,000 deduction for the property, you'll be taxed at $115,000. You won't get $35,000 back. You'll just be taxed at $115,000 as opposed to $150,000. Now you might earn $20,000 worth of rent from the property, so that will increase your taxable income from $115,000 back to $135,000 per annum. So there's a difference still of $15,000 worth of taxable income from what you actually earned to the balance minus outgoing expenses and incoming rent from your investment property. So how that works is, instead of you being taxed at $150,000, the ATO will now only tax you at $135,000. Now remembering the tax scale, every taxable dollar you earn over $90,000, you're being taxed at close to 40 cents in the dollar. So if you're getting a taxable income write-down of $15,000, you're getting back 40 cents, nearly 40 cents in every dollar of that $15,000 difference. That's significant, isn't it? That's half, so nearly half. So that's about $6,000 a year of net tax refund. Now where the utilisation comes in is, let's say with a property, you're getting now the initial income stream that you're generating is rent. And we're saying that was going to be $20,000 a year. But now we've also generated a net tax refund, net tax, as in this is the real amount that you will get back every year, of $6,000. So when we combine that to that, what we're able to do is we've generated another $6,000 worth of net income. And when we couple that with the rent, we can take ownership of a property in a positively geared fashion. So I'm utilising my income tax to generate additional cash flow to turn an investment property from what may have been a negatively geared scenario with only the rent being utilised into a positively geared scenario with the actual net refund going back into your pay. And I'll show you how we can actually get that in advance via a tax variation in our mortgage reduction video next. But quite literally, How many positively geared investment properties would you like to own, where you're literally getting paid to take ownership of an investment property? So instead of just actually, putting it into a $200,000 superannuation account, you're now being able to take ownership of, let's say the property's worth $500,000. So you're now being able to utilise your tax to take ownership with the rent of a $500,000 asset, let's say. To me, big difference between saving and utilisation of your tax. I hope that makes sense. Bye for now. If you found this information helpful, or you think it can help someone you know, please share the link or tag them below.